This video is to be used for educational purposes only and is not intended to replace individual research or licensed investment advice. Unique experiences and past performance does not guarantee future results. Trading stocks, options, and spot currencies involves substantial risk, and there's always the potential for loss. Your trading results may vary. No representations are being made that any software or training will guarantee profits or not result in losses from trading. This is the Premier Trade FOREX Report with Scott Norse.
Good afternoon, traders. I'm Scott Norse here, wrapping up the week. Today is Friday, February 22nd, 2008. Well, the dollar had a very difficult time staying afloat this week, and we are at least a little surprised that the currency did not free fall today. The bad news has been piling up in terms of weak data from the U.S., and this week's economic lineup was no different. While the calendar was on the light side, the few reports we did see consisted mostly of multi-year lows, declines, etc. The only thing we saw move higher was the jobless claims figure, which is the wrong way. The Fed minutes from the January meeting were also released midweek. Most of the comments pointed toward further easing, at least through the summer. Most economists expect rates will fall to at least 2%. However, the Fed tried to anchor inflation expectations by saying it will reverse the cuts rapidly when the economy stabilizes. 48 hours later, we can see that neither stocks nor the dollar really found that statement appealing. Economic reports from around the G7 continue to offer us mixed signals at best. Recent reports out of the UK have been mostly dismal, but retail sales yesterday came in much stronger than expected. The pound has since gained more than 200 points on the dollar from a triple bottom formation on the daily charts. European data is a mixed picture, to say the least. More than a handful of reports show confidence among consumers and businesses dwindling, while other reports indicate the economy is still chugging along. The ECB again lowered its 2008 growth forecast, which now lies at just 1.8%. However, the inflation outlook and recent wage gains leave the central bank rejecting calls for rate cuts. Canada is also offering a murky outlook, with today's retail sales figures the latest signs of weakness. Core sales came in much worse than expected for December, making the CAD one of the few currencies that the dollar was able to advance against. Now to the big picture. Given the frequency of changing mindsets in most financial markets, it appears as though nobody is really thinking big picture. Many traders are in survival mode and simply trying to get through the volatility. This means that short-term trading is our best approach, even when it seems like long-term trends are forming. After all, if we realize that we took profits on a winner too early, we can always reestablish the position. What we don't want to do is expect too much one-way activity in such uncertain times and fail to ever reach our profit targets because they're unrealistic. Overall, if we were forced to pick a long-term direction for the dollar, we'd have to say lower. On the surface, the fundamental backdrop is very weak. However, much of the negativity, pessimism, and bad news have been priced into the greenback, so we must be cautious of rebounds, regardless of how unwarranted they may seem. We would not go as far as ruling out another leg lower in the buck before any significant rebound, and it may be as early as next week if Bernanke hangs the buck out to dry. In the meantime, we suggest traders keep profit targets on both sides of the market reasonable and maintain the discipline to take profits when those targets are reached. Till next week, enjoy your weekend. Take care.